Hey friends, over the past couple of years of staying in touch with clients that I've helped since 2020, so let's just say over the last 4 years, a few things have become really clear to me, and I'm going to give you some information today that is going to help you whether you're in bucket 1 or bucket 2, I promise you. So I'll get to my 2024, 2025 right here. Refinance rate tracker process that I'm going to roll out starting this week. But I want to share a couple of those things that have become really clear to me. 2 things. Number 1, I helped a lot of clients 2 times as many typically. So I normally in an average year help about 200 families finance real estate. In 2020 and 2021 each year, I helped over 400 families. So twice the amount of families helped in a very short period of time. So I've got a larger group of clients to take care of, to stay in touch with. And what I have found out by the group of people that I helped from 2020 to, let's just say early 2022, to the people that I've helped from 2022 to current in a higher interest rate environment has been twofold. Number 1, I've got a lot of clients right now with low 30-year fixed rates, low monthly payments, but they're in a house that they don't necessarily love, or they've taken on a lot of debt and they need to do something about it. So I'm helping them with some scenarios. More so it's a mindset thing. How do I get rid of a 3% 30-year fixed and jump into a 6.5% 30-year fixed? It makes sense if you're upgrading. It makes sense if you're paying down high interest credit card debt. Reach out to me if you're in bucket number 1. And I can walk you through a process that I'm taking a lot of clients through right now and helping save you thousands of dollars, or helping putting you in a better housing situation. Now, bucket number 2 are clients that I have right now with high interest rates, 6.5%, 7.5%, 8% plus 30-year fixed rates. These particular clients got a great deal on a house because there wasn't a lot of escalations, even though houses continue to go up in value. So they got a great deal, locked in a great value on a home, but they're paying premium for it because of high interest rates. All of my clients over the last 3 years are victims of high inflation. So the cost of goods, the cost of living, everything's gone through the roof. I believe Americans need a break, and it's coming. And so this is the reason why right here, the refinance rate tracker program or process that I'm rolling out in my business, I am going to give you as a client of mine, or if you find this on YouTube or on social media, I'm going to give you information every single week that's going to help keep you in the know. I think that we're coming down the backside of this high inflation, high interest rate market. I've got data and I've got proof that proves that. With recently the Fed coming out saying as early as September, they're going to start pulling back and reducing the Fed rate. Now, currently, the Fed funds rate is about 5.33%. It's right in line with their benchmark, their target mark. They wanted to be between 5 and 5.5 to curb inflation. I don't know if they've curbed inflation. Okay, but they've done enough. I think that the damage has been done to the economy because now we're starting to see unemployment numbers rise. That's the key factor. I was focusing on inflation. I was focusing on the Fed rate. Now I'm focusing on unemployment numbers. And I think the Fed is doing it as well. So they've come out and they've said that in September, they're going to start reducing the Fed rate up to 200 basis points over their next 8 meetings. Okay, so that's a lot. 200 basis points is 2 percentage points. So if it's at 5.3 right now, getting it down to 3 to 3.25 is ideally where they're going to be over the next year or so. What that looks like in regards to mortgage interest rates is good news. Mortgage rates do not directly move with the Fed rate, but they'll indirectly move with the Fed rate, okay? And so I believe as the Fed, and I don't believe there's data to support this, that as the Fed continues to drop the Fed rate, mortgage rates will drop as well because of inflation, because of unemployment numbers, and they're gonna wanna speed up the economy as a result of that. Okay, so what am I going to do about this? I'm going to give you a 1 to 3 minute video once a week. And what I'm going to do is I'm going to let you know where 30-year fixed rates are this week compared to last week and what they're doing, what's going on in the economy, and what I believe is going to happen in the future with that. So what does this mean to you? If you own a home and you have an interest rate that is higher than about 5.5%, I want you to follow this. I want you to follow me. I want you to reach out to me and I can add you to my client list where I give you a little bit of additional information and strategy. But I want you to pay close attention. I believe in the next 1 I think 6 to 15 months, we're going to see some good movement in the market that will help benefit you. Now, if you have credit card debt, if you've taken on some debt that you're not proud of, it is what it is. I can help do something about that. I want you to reach out to me, and I want to run you through a report that I've made for my clients like you that takes a total household blended debt analysis. And what we'll do is we'll see if a refinance or a home equity line of credit makes sense in the meantime to help give you some breathing room relative to high interest credit card debt. I take a lot of pride in being able to watch the market. I take a lot of pride to have over 2,000 past clients that lean on me for information. And I want you to reach out to me if you have any questions. I hope you enjoy this information every week until it's not necessary. I'll be bringing you 1 to 2, 1 to 3 minute videos on the market relative to interest rates and how that can benefit you. All right. We'll see you on the next call next week. Bye for now.